Hey guys, I'm Yonik and I'm one of the trainer at Alpha Investor here. So in today's webinar, we're going to talk about what happened to Facebook. Is it an opportunity or is it a falling knife? Alright, so Facebook is this. That I'm pretty sure most of you guys know what is Facebook. So ticker symbol is FB. So if you do not know, you can go check it out on what happened recently on the stock chart, or just do a quick Google on it, etc. etc. Now, for more information about stocks trading or stocks investing, you can actually visit our website for free and no bullshit stock course. Right, it's absolutely free at alphainvestor.edu.teachable.com/p/beginner investor. Right, don't be mistaken. Beginner investor doesn't mean that it's purely for beginners. It's free. Just go on there. It's really, I put in a lot of effort and time into all those the course series. So do check it out if you actually find it useful, right? If you find this video useful, right? So now in this video, we're going to talk about three main parts. So three types of analysis we're going to talk about will be fundamental analysis, which we will talk about economic mode. Second one will be on financial analysis, where we go through the financial metrics of it. Third one will be on technical analysis, whereby we go in depth into the charts of Facebook. Alright, okay, so now let's move on. For those people that do not know what Facebook is, or those people are living under a rock, Facebook is basically an American online social media and social networking service company. Popular programs that Facebook owns includes Facebook itself, alright, at 2.2 billion active user per year, Instagram with 1 billion active user per year, and WhatsApp with 1.5 active billion user per year. The world only has an estimated of 7.7 billion people. So you can imagine that Facebook technically kind of owns 1/3 of the world's population, in terms of they use their software, use their application for their day-to-day life stuff, right? So Facebook main source of revenue is advertising. This is really a no-brainer thing, because that's what Mark Zuckerberg told the Congress when he was being questioned for the Cambridge Analytica incident. The revenue at 2007 was just 150 million. Right now, 10 years later, the revenue is $40.6 billion. So you can imagine how much money has they made since 10 years ago. Alright, now let's move on to the next part, where we talk about what happened in the charts itself first, before we talk about what happened fundamentally, because from one look at the chart, you can basically tell why we're doing this video already. Alright, so let's go. So Facebook has basically went up around 89.39% since 2017. So you can see it went all the way up to here, and then it crashed all the way down, right? So you can see in the next chart here, Facebook actually crashed down 22% in just one day. So this is the reason why we're looking so in depth in this particular stock, to see whether it is actually worth our time to invest our money and resources into this stock. So I'm doing all this research for you guys, so you guys don't have to. Now, this 22% crash downwards is equivalent to $100 billion. So CNBC reported Facebook 100 billion plus, but then Market Watch says that it's estimated $120 billion loss, and if you actually calculate 120 billion loss, it is actually the biggest loss up to date for every single stock. So Intel also had their loss ranking below Facebook. Now Facebook is actually the highest ranking now in terms of the amount lost in just one day. Now, how much is $120 billion? Well, to those that are not very sure, I have broken it down for you guys. So $120 billion is worth one McDonald's, the whole of McDonald's basically, right? So you basically see next day the whole of McDonald's just disappear from the face of earth, or the whole of Nike or Adobe. All these are softwares, and brands that we all are familiar with. It just wipe out like that. They're gone from existence. If you talk about if you talk about the social media perspective, Facebook is basically $120 billion, is basically 2 times of Twitter, 2 times of Snapchat, and 2 times of Weibo. Weibo is a social media in China, so there's 2 times of Weibo. That is how much $120 billion is worth. Now, when we look at Facebook's past earnings, of 19 earnings since January 2014, Facebook has 19 EPS beats, 17 revenue beats, of average a 45% growth year over year. Now, this source is from Seeking Alpha. As you can see, this picture is actually copy paste from Seeking Alpha. So you can go to their website and take a look. The link is just over here. Just simply copy paste on, and you can access it and you can see it for yourself. So now, what happened this time round? Well, in the 3 months ended 2018 quarter, which is the second quarter of Facebook, they actually reported revenue year over year change that it actually increased 42%, which is a good thing. So their net income also increased by 31%, which is also a good thing. EPS increased by 32%, which is also a good thing. Furthermore, in the non-financial metrics, daily active users were up 11% year over year. Monthly active users were up 11% year over year. Mobile advertising revenue was up. It went up approximately 87%. Cash equivalent is they are holding $42.31 billion in cash. So this actually represents a very, very strong business business model that Facebook actually developed over the years. So why the crash? Well, the crash is partly and mainly due to this statement that is by the CFO of Facebook. So turning to the revenue outlook, the total revenue growth rate decelerated approximately 7 percentage points in quarter 2 compared to quarter 1. Our total revenue growth rates will continue to decelerate in the second half of 2018, and we expect our revenue growth rate to decline by high single-digit percentage from prior quarters sequentially in both quarter 3 and quarter 4. So this statement basically tells us that Facebook is going to slow down in terms of its revenue, and revenue often equates to demand. So if revenue slows down, means the demand is going down. So that sparked all of the investors and all the analysts, and then they all start to panic sell and short sell on Facebook. So now if you break this statement down, let's understand more about this statement. So if you break this statement down, if there's a 42% year-over-year growth for second quarter 2018, as we've seen over here just now, right? Let me find the right. Yeah, 42%, right? So if there's a 42% year-over-year growth for second quarter, a high single-digit deceleration in revenue growth estimate is around 9% deceleration, right? Because we put it as high, and that's the highest single-digit. With that said, this means that quarter 3 revenue growth will be around 33%, because 42 minus 9, you get 33. And then, because it's sequentially, so the quarter 4 revenue growth will be 24%, right? So now 24%. Let's move on to the calculator with an estimator of 24% growth towards 2019, and let's include fundamental analysis and financial analysis. So let's check it out, right? So now coming to the Excel calculator, the valuation calculator by Alpha Investor, which I have actually coded it from scratch. Every single thing about this is actually proprietary. So what I'm going to show you guys is really the next level valuation calculator. So now let's put in the ticker symbol Facebook, right? So what happens now when I press get data is that this Excel calculator will go online and script for all the data. So you can see all the codes behind are working. The mouse is, it's showing that it's loading, it's going online from NASDAQ, from all over the news, all over the internet, to get every single data it can about Facebook and compile it back into this calculator here. So in this calculator, yes, it's kind of loading a bit slow, but because there's so much information to script from the net, and it's done. We're done. So now it tells you what this company do. Basically every single thing is over here. It tells you the technology, which industry, which stock type, number of employees that they own, and large growth, etc. etc. It also tells you about the price to earning ratio, PEG. You can actually take a look at every single thing here. It tells you the biggest competitor again and its market cap against the competitor, how much it's worth, etc. Right? Now, moving on to the first part on economic modes and tips assessment, which is the fundamental analysis. So let's fill this up very, very quickly. Well, do you think that Facebook has a brand, has intangible assets? Well, I think that they have a very strong brand. So we give it some point. There's strong network effect because there's over 2 billion users. There's more than 2 billion users, and the value increases when the number of users increases. Facebook also have a monopoly scale because in terms of advertising, if you want to advertise your products, you either go to Alphabet, which is Google, or Facebook. You don't go to Twitter, you don't go to Snapchat, you don't go to Tumblr or whatever, right? So you just purely goes to Facebook or Alphabet. So it's kind of considered oligopoly, but oligopoly is one of the best that that the investing market have, because monopoly markets are not really very realistic. So we give it point for that. Now, are there cost advantage for Facebook? Yes, I would say there is cost advantage for Facebook because their network and all their database is so huge. They do purely on advertising, and advertising requires database, every single information about the particular user, etc. etc. So they have a huge database, and hence they have cost advantage. Now, next, moving on to switching costs. Do you think they have switching costs? Well, I personally think that Facebook offers very, very cheap yet efficient advertising to their customers. Therefore, if you were to switch your advertisement to other companies, like maybe Twitter, etc., they will not actually be able to generate you as much growth in your company as before. So I believe that there's switching costs and pricing power, because Facebook allows you to flexibly use your price, any price you want. You can actually compete. You can actually put your advertisement at just $1 per day, and it's okay. And the best part I like about it is it actually have this concept of, people don't actually realize it, but if you actually go in depth and look at it, it's actually a recurring revenue. So once you go on Facebook, you will keep recurring that $1. If you go on $5, you will always recur $5. If you're a big company that does huge on advertising, you will probably spend like maybe $100 a day, and you multiply that by 365 days, and that's just one company, right? And that company may be a bit small. If you talk about like super big companies like Apple or other companies like Microsoft, etc., they may be spending thousands of dollars per day, and you multiply it by 365 days, how much would that be? So the pricing power is there. Now, next, looking at tips assessment. Well, first of all, is there technological risk? What if Facebook actually closed down and they are being restricted off the internet? So there is technological risk, so we give it 0 points. There is no inflation risk in my opinion, because you are actually flexible to price your advertisement any single price you want. So I don't think there's inflation risk. Are there political risk? Yes, there is political risk after the Cambridge Analytica incident. But then what Facebook is saying, that they are actually aggressively trying to hire more people to monitor the market, to monitor their Facebook application, to make sure that there is no such incident happening again. Now, is there specific people risk? Yeah, I would say that there is actually specific people risk because the whole company depends heavily on Mark Zuckerberg and his partner Sheryl. I can't remember the last name, but Sheryl something. Yeah. So the whole company actually depends heavily on them. So therefore, I will not give it any points. So with that said, it's got 0.5 upon 2. So now moving on to financial assessment, as you can see here, all is done for you over here because of our back-end coding. It actually scrapes all the data from here, so you can see that all the financial metrics, every single thing over here. You can see that revenue is actually increasing over the month, and if there's something that worth taking note of, they'll actually show you in red. So we can see that operating income in the year 2012 actually went down, so it's something to take note of. Net was this, operating margin also went down in 2015, so it's something to take note of. Shares are actually increasing, the number of shares are increasing, but it is not a huge concern because EPS is also increasing. If shares are increasing and the EPS are decreasing, then there is a huge red flag you should look out for. So having said that, it actually compiled everything for you here. You have actually see that revenue is positive operating cash flow, positive free cash flow, consistent gross profit margin above 40%, right? Now here you can see that gross profit margin is at 86%. Moving on, increasing earnings per share over the past few years. Debt to equity ratio under 0.5. How do we know that? It's because we look at the financial matrix, we scroll all the way down. Debt to equity is 0. There is no short-term debt, there is no long-term debt at all for this company. So remember, and I shared with you guys earlier that they actually own $42 billion in cash, and they do not even owe a single cent. So imagine how rich, how financially strong this company is. Now moving on, return of asset is above 7%, which is a good thing. Return of equity is above 15%, also a good thing. Free cash flow above 5%, also a good thing. That's how we score 5.5 upon 6. So now looking at red flag indicator, one thing to highlight is that there is a decrease in the return of equity. Means that, let's take a look at it. Return of equity. So we have noticed that in this year, in 2017, the return of equity is only 23.84%, whereas compared to the year 2010, there is actually a decrease over the years, but it is still above 15%. So it's alright. I think we're cool with it. We can still continue to put our money in it. So end of the day, we have a confidence index of 8.5 upon 10, and therefore the system actually prompt you that you can actually proceed on into investing in this company. So you can see that Facebook has strong moat and strong financials, and their tips assessment isn't that good, but their red flag risk isn't that is actually quite healthy. The financials are actually quite healthy because the red flag indicator is signaling that it's quite low. So now we can look at the 4-month chart for Nasdaq, but we don't have to look at it because I have actually shown you guys the chart already. There's actually other variables down here, but let's go on to the first thing, the growth entry price. So now looking at growth entry price, we can see that over the past few years, everything has been keyed in for you already once you press get data. So you will key in the past EPS, then key in current EPS here. Over past 6 years, Facebook has actually grown 50.71% CAGR. Alright, now EPS growth rate is 50.71. According to Morningstar, the growth rate is actually 0, but because this company is not 10 years yet, we shall actually use a growth rate of 24%, which is what we calculated earlier. You can actually go back in the video and see that the slide whereby we talk about 9% deceleration in revenue growth. So we put it at 24. We found out that the average entry price is $176.58, and what price is it now? It is at $172.76. So a few days ago, Facebook is at $218. That is way overvalued. Now Facebook has crashed all the way down for us, and it's like a sales for us right now. So it's maybe a good time for you to grab some Facebook stock. Well, Do take note, all these are actually my personal opinion, and whatever I say are not supposed to influence you in any way to take any action. End of the day, you still have to do your own thorough research, and it's your money, your risk appetite, so you do have to take note of it, right? So now let's move on. Facebook does not give out any dividends, so we can forget about it, forget about Facebook. In Facebook asset wise, we can see that Facebook, it's only worth entering Facebook for their assets if it's at $19.60. So we can just forget about it, throw it away, don't look at it. All we have to be concerned about is the growth. So you can see that it is undervalued. It may be a good time for us to invest. So we can look at financial matrix. You can actually go and see there's actually not much red. Even if this is highlighted in red, it's still a good thing because their EPS is up. So it's basically very, very clean, very, very healthy financial records. You can pause this video at any time. I'm just slowly scrolling it down. You can pause this video at any time to check it out if you need to. So you look at the balance sheet, right? It's also quite good, quite impressive. Look at the income statement. It's also very, very impressive, whereby you see net income over the years has actually been increasing dramatically, almost 10 times. Alright, almost 10 times. From 2013 to 2017, there's almost 10 times increase in net income. So now you can actually take a look at competitors, but to be honest, nothing much really is very significant unless you're talking about Alphabet, which is the parent company of Google, or you're talking about Tencent Holdings. Alright, so now with that said, I like to introduce you guys to this thing called the price movement table. So in this price movement table, you can see that we have sampled data of 3 years. Number of days is 252 days sampled, because there is 252 days trading days in a year. So with that, this is a nominal distribution, and actually calculate out the implied volatility, etc., and you get 33%. So the expected movement range of Facebook in 70 days time will be, it will actually move all the way to $151.48, or it might move up to $194.04. So if you think about it, there is a 34% chance that it will go upwards, or 34% chance it will go downwards, but you know for sure that there's a 68% chance that Facebook will fall between this price range. So what can you do? Well, if you're an option seller, you're in luck, because you can actually sell out of the money put, or in the money, or at the money put at this price 70 days out, and I'm pretty sure you'll still get a very decent profit from it. You don't believe me? Well, you can actually check out your platform, or you can check out Google. We can just do a quick Google on the option chains of Facebook. You can see it. So if you're doing a 1 day trade, it's around this price range. 1 week trade is with this price range. 1 month and 70 days will be here. So you can change. If you're not looking for 70 days, you're looking for 100 days. It will change accordingly once you just type in that. So this calculator actually does every single thing for you in terms of the economic modes, in terms of the financials, and in terms of what should you do if you are doing options for it. So is it an opportunity or not? It's really up to you, but let's move on to the technicals. So now we are in my Thinkorswim live account, where you get to see real life data where Facebook is currently trading right now at this timing. So what are we looking at in this chart? Well, we are looking at potential support or resistance line that we can actually look towards entering or exiting the stock. Now, what happened when it dropped all the way down here? So usually what I like you to do is, when a stock moves so much down, you like to either buy in a fraction of the stock, just a small bit, just for maybe a potential upside movement. If it doesn't move up, then it will continue to go down. That's why you buy a small bit. You don't go all in on it. So what do? You wait around 3 days for the stock to cool down, for the short sellers to stop selling. Then you start to buy and see, you wait 3 days and it actually went up. Now, when you look at this 3 days later, or you look at this point, the third day, so you can actually see from the third day itself, you bring back all the way, you can actually see that. Let me just draw the line here, the support line, support line here. So you can see that stock price has been actually bouncing off this level every single time since September or maybe August. Let's put it as August 2017. It's 2017 itself. It bounced off this line. It actually almost touched this line and bounced off. Same goes for here. And when you break past this line, it became a resistance until it actually get up and go all the way up. So some people says that stock always come back to where it gapped from, and true enough, it's actually coming back to where it gapped from. It's covering the gap. So in this case, it might potentially cover back this gap in the long run, but we will see. But you can see here that this is actually a very, very important support line where the bulls are actually keeping the stock alive. This is actually not coincidental. It's actually calculated by all the boards and all the fund managers, all their machines and all their proprietary trading, every single thing inside them. It's actually all calculated by them already. So that's how you get back this amount, this price zone here. So now what happens if this price actually breaks downwards? Then you'll potentially get to see that you will actually be around, the next support line will be around this mark, $149.02. So right now what you can do is that you can actually see that there's actually a potential upside movement, because it came all the way down of actually until around 100, and let me check the calculator just now. It is my price movement. So in 100 days time, it might potentially move up to $198.19. So it's around here. You have potential upside movement of this much, whereby that similarly it might move to $147, which is also coincidentally near your second support line. So you can see that the movement, it is actually a pretty strong signal for us that hey, it may be a potentially good time for us to enter the stock. So even if it comes down all the way down, this support line might actually have a rebound for you, unless it actually breaks past the support line too. If it breaks past this support line, then you probably should cut loss and take out all your money, because the market isn't just moving in the direction you want it to. So now, with this, having said this, let's take a look at the Fibonacci retracement. So Fibonacci retracement, let's go. So yeah, so we can see Fibonacci is always used at the lowest point to the highest point. So with this, we actually draw this Fibonacci retracement all the way up to this high. You can see that the stock price now is currently flirting around this 61.8% drawdown. So 61.8% is actually a very, very strong and very, very important number. If you don't believe me, you can go ahead and YouTube for any other people's video on Fibonacci retracement, tutorials on it, how to actually read it, etc. So it's actually a very, very strong support line there, 61.8%. So means that this stock actually went down from based on this calculation of low to high, it actually went down 61.8% already. So having said that, it actually signals it points out another good signal for us to actually enter the stock again. Now, if you are a trader, then perhaps it's not a good time for you to enter, because it seems like it is not able to break out from this point of $180. But if you are a long-term investor, you do not care about short term, this is the sales for you. This is the opportunity of the lifetime. Either you get in or you stand to lose out. It's as simple as that. So now, if you are a trader, you like to wait for a more positive candlestick movement upwards before you get in. But if you are an investor, I think a red day is always a good day for you to invest. You do not invest in a green day. You always invest in the red day. So it's actually a pretty good day for you to invest in the long run. Now, short short-term price movements are always controlled by emotions, whereas long-term price movements are always controlled by stable minds and stable minds that actually are able to pull on through all the hard times and all the tough times. So now, here's my quick takeaway. The potential upside for Facebook is a lot, because first of all, we calculated an intrinsic value of $176. Now it's at $171, so it's undervalued. Second, it is around its major support line, so it kind of suggests that it will be supported around that region and your potential upside is higher. Third, based on the Fibonacci retracement, we can see that is actually around the 61.8%, which is a very significant level for it to bounce back up. Fourth, if this trade were to go wrong, you will potentially go all the way down to $149 or $147 if you're talking about 100 days using the implied volatility calculation. So the potential movement upside is still very, very strong. Even if it drops all the way down, you can make another entry into it, double down, unless it really breaks past and actually goes all the way down. Then that's the time where you stop loss. Alright, so all in all, the decision still lies with you. You may choose to invest in Facebook or not, it's really up to you, but that's just my quick takeaway. So now, for more information about stock investing or educational videos on stocks, do visit our website at alphainvestoredu.teachable.com. Right, you can actually find out all our videos, all our course series are actually posted up there. Unfortunately, the valuation calculator is not yet fully developed. I'm still working with my developers to develop it online for for users like you and I, for everybody to use it. So do stay tuned. But well, you may still visit the website and use all the other resources for now. So I'll see you there at alphainvestoreducation.com, and hope that we can actually build a long-term and sustainable portfolio in the long run. So I'll see you there.